Welcome again. And the intention behind these discussions is to not only keep you inspired during these times, but it's to also equip you with knowledge that you can't always gain from watching the news or reading articles. And it's to also connect you with leading entrepreneurs with firsthand knowledge that can help guide you along the way. So to keep engaged, please use the Q&A box to ask our speakers questions, and we'll keep an eye on the chat thread on the side. And so without further ado, I'm excited to introduce the person who is going to steer our conversation for today, Bunker Labs master facilitator and the man who inspires us all on a daily basis, Todd Connor. Hi, Todd. How are you?
All right. Good, Jada. Thank you so much for organizing and getting us pulled together for these important conversations. And really excited for our conversation this morning with George Khalife. George, good to see you. Thanks for joining us this morning.
Yeah, thanks, Todd. Thanks, Jada. That was an awesome intro. And thanks to everyone for attending, and hope you're all doing well, in spite of what's happening. And just also a quick shout out before we move forward, and a quick thanks to all the veteran entrepreneurs and military spouses if they are listening. So thanks for your service, and very happy to be here.
Awesome. Thanks, George. So George, we're going to talk this morning, and I'm actually excited for this conversation about going public and the role that exchanges play in that process. This is an area that I don't know a lot about. I think a lot of folks understand the notion of a company going public, but we're going to ask questions like, why go public? How do you go public? How do you choose an exchange? If you are going to go public, what are the implications for that? George wears a number of hats, but he's a co-founder and CEO at Bookback. So he's an entrepreneur himself. He hosts a popular podcast called Let's Grab Coffee. He has a blog and then does a lot as a speaker and community builder. His day job is I'll let him talk about it, but is working for the Toronto Stock Exchange, and is tasked with starting up the Chicago office and helping kind of tell the story across the Midwest about the Toronto Stock Exchange and what the options are for companies that are going public in the United States. So, George, I'm going to just kick us off. Tell us a little bit about maybe just the Toronto Stock Exchange, and then I want to sort of posit a question like, what does it mean to go public? What kind of companies go public? What's the purpose of an exchange in the process of going public? Just give us kind of an overview of the landscape.
Yeah, for sure. Well, thanks, Todd. Maybe if we just also kind of take a quick step back to and we were talking about this before this started, but really, like, what role are we trying to play, right? Especially if you look at the U.S., the Midwest. I'm based obviously in Chicago, but do cover in the Midwest. And really what we're trying to do is for founders, entrepreneurs listening who are thinking of raising capital, what I'm trying to do personally is on that menu of financing options, really position public capital, which is what you can raise via the Toronto Stock Exchange, but also the TSX Venture Exchange, to help with several different benefits, whether that's growth, acquisitions, and we'll go through different reasons. But just kind of as a starting point and as maybe a lay of the land, if you look at kind of just the U.S. markets, and maybe we can start there. The interesting thing to note is going public typically in the U.S. occurs at a much later stage, right? So let's take Illinois as an example. I did a bit of research on maybe the past 10 years of companies that actually went public. And if you look at just their metrics, and there was I think about 13 with properly disclosed financials, they had on average revenues of probably I think $1 billion in revenue. Their IPO raises on average were about 146 million, and their valuations were close to $1 billion. What that really suggests is that typically in the US, if you want to go public, it happens at a much later stage. And so that's why when you're talking to entrepreneurs, that notion of going public isn't necessarily at an earlier stage as it would be in Canada. So the market there is very, very different. For people listening, we have a two-tiered marketplace. That's kind of what we call it. The TSX is, as people maybe might expect, for more later stage companies. So these are established businesses, stable operations. They're growing. They're typically they have market caps of probably 80 million or more, whereas the venture exchange or the TSXV is actually for earlier stage companies. So these are companies typically raising anywhere between 2 to 20 million, right? And the reason why we have this setup, I'll start with this analogy to kind of create that lay of the land for basketball fans. I always refer to it as a basketball player going from the NCAA to the NBA. So for those watching The Last Dance right now, this is like Jordan going from North Carolina to the Bulls. So that's why we have this two-tiered setup, right? It gives a chance for companies to operate as a public entity on the venture, and then when they're ready, uplist to the TSX. And we've seen almost 700 companies do that. So just kind of a quick context of maybe the market overview.
It's really interesting. So how many exchanges are there? I mean, just give me a size of the sector. I mean, I guess obviously Chicago has a few exchanges, but can you just kind of talk about what do we have in Chicago, and then what do we have in the country? And then a follow-on question to that is, does it matter where your company is based for the exchange that you choose to list in?
Yeah, it's a good question. If you look at kind of the U.S. just broadly, the two major U.S. exchanges are obviously NASDAQ and the New York Stock Exchange. And if you look at the TSX, it really is one of the leading global peers among the world exchanges. I think in 2019 we ranked second in terms of new listings and IPOs, and also second among global peers in terms of international listings, right? And if you look at both the exchanges that I was talking about, the TSX or the Venture Exchange, we have about 3,200 companies spread across both exchanges. And right now in the US, we have roughly 120 companies that are listed here. And a question you asked, which is very, very, very good question, is do you have to be a Canadian company, as an example? And that's something that typically people will ask is, do we have to be incorporated in Canada? And the quick answer is no. You can actually be domiciled in the US and still pursue a public listing on both the Venture or the TSX. Typically, what we do recommend is just having some exposure to Canada for, kind of access to investors and kind of more awareness or publicity from that aspect. And it is variable. Some US companies have exposure, right? Whether it's through investors, a customer base, could be a product, an alternate office. In some cases, that does help, right? Sell the story, raise capital in Canada, but in no means is it an official requirement.
So let's play with the venture model a little bit, where you said $2 to $20 million, the Toronto Stock Exchange venture. So are these companies that have venture backing, but they're also looking to get public investments, and so that's a reason to list? Or talk to us a little bit more about what that scenario looks like.
Yeah, for sure. So if you look at the TSX Venture Exchange, right? I mean, no different. And maybe if we kind of look at the full life cycle of a startup, right?
Mm-hmm.
From inception to its kind of maturity, there are different avenues to raise money, right? It typically starts by the founders themselves. They might then do friends and family round, then they'll do an angel round potentially, and then they'll start going into the traditional capital that we all know of, right? Which is the VCs, the private equity potentially, and et cetera. That's kind of on the private side, right? If you look at kind of where the TSX Venture Exchange fits in this whole model, it's really from, I would say, kind of prototype stage all the way up until past commercialization, or where a company is, producing stably, I would say, and really growing. The TSX comes after that, right? So it's kind of more later stage. So if you had kind of quick metrics to look at, typically we see companies of market caps of less than 75 mil on the TSX Venture Exchange, and they're typically raising anywhere, as I said, between say 2 to 20 million, and the average right now is about 4 to 5 million. So this is really no different than maybe your Series A, as an example, for founders who have more of a concrete concept of what private capital looks like. And the question really, Todd, is why would a more earlier stage company pursue this? Right? I think that's kind of the real golden nugget. Like, what are the reasons? Why? What are the benefits? Why would I do this right now? And I think that there are very different reasons, okay, in different situations, and maybe we can walk through them if that's okay. For one, I would say access to capital, right? If you look at kind of the TSX, the Venture Exchange, last year, the innovation sector, which for us is tech, clean tech, life sci, was actually the number one sector. And we raised almost $14.5 billion across exchanges for the innovation sector, and it's been really a driving force and a place where we're putting a lot of attention and a lot of effort. So access to capital is one. The other thing too to note is in Canada, we really have a robust environment of bankers who really like small to mid cap companies. So and that's a bit of a difference between the US and Canadian market, where if you look at kind of the investment bank, we have the environment suitable to help finance these earlier stage companies on the public markets. The other one, which is typically a common one to talk about, is using your shares when you do go public using your shares as a form of currency to make acquisitions. So you think of, a company doing, let's say, 8 million in revenue. It's a tech company, and they plan out to roll a couple of acquisitions. I mean, typically, if you're private, you're going to use cash, right? The issue with that is obviously it's not tax efficient, it's not cost effective. But then when you are public, you can use those shares, and we see that all the time. And these are subsequent acquisitions. It's not just like a one-off. So we do see that, especially with successful companies on the venture. Another couple of reasons I would say is liquidity, awareness, right? That kind of exposure and credibility that you get even as a earlier company. And then stock incentives, right? For employees to participate in the growth and the success of the business is a great thing. And maybe lastly is liquidity, right? Typically companies who have investors, especially investors early in the game who have held on for quite some time, this is an opportunity for them to exit the business in a fruitful way. It's not typically the one we love to see as like the primary reason to go public, but it definitely is, I would say, an ancillary benefit or an ancillary reason maybe to doing so.
Interesting. So for companies that are in that $2 to $20 million range, or kind of fulfill the profile that you've just articulated, what is the consideration on the exchanges side for which companies to allow to be listed, or what does that marketplace look like? So, the entrepreneur thinks, for the reasons you articulated, I want the infusion of capital. I want to create stock options as a mechanism for acquisitions or for employee retention or what have you. What is the consideration for an exchange to say, yes, you can be listed with us? Are there fees, or, how do you think about that?
Yeah, for sure. And so obviously this definitely depends on the sector that you're in. We have a really nice kind of guide to listing that you can find online that kind of lays this out really, really simply, to be honest. It's kind of different categories of requirements. So typically a company is going to file an initial listing application, which sort of sees, do you meet the initial requirements from the exchange's perspective? That's the first thing. And I think that depends obviously on sector. So if you're a tech company, those requirements are going to be different. It also depends on the size and which exchange you're looking to list on. Whether that's the venture exchange or the TSX, those are also different. I would say for people listening, I think this would be just, I guess, relevant, but also give a quick example of what are some of the things that we would look at. I would say right now, it's, especially for my focus being in the Midwest, it would be either a company in tech or life sciences. And by the way, this is agnostic. It's not a vertical of tech or a vertical of life sci, and it could be med tech. So on the tech side, you're seeing a lot of freight tech, for example, here in Chicago, a lot of logistics. In Pittsburgh, you probably would see more med tech, right? A lot of more health tech or life sci. So it's very regional focused. I would say companies doing at least 4 to 5 million in revenues to start. That's not a requirement per se, but it is more of what bankers right now are looking at. So and we've had conversations with them recently, and I think from their perspective, they want to see obviously some traction, right? So if you look at kind of the requirements, there aren't necessarily strict requirements in terms of revenue or profitability. There are certain things where we want to look at, whether it is revenue or working capital. We do look at the senior management team. We want to see that you have at least 2 independent directors on the board. These are some high level things. And as I said, the connection to Canada is I think more of an advantage now. It's not, it doesn't necessarily mean that it's a requirement, but it's something that the bankers are definitely looking at. So I would say that's definitely the starting point. And relative to fees, that depends on the process, which we can talk about for sure. How do we actually do this? Like, what does the process look like, and how does that happen for earlier stage companies? So that will depend.
Yeah, but the idea is that, and this is maybe obvious, but I'll state it, that the exchange isn't the investor. So the exchange is really the mechanism whereby the entrepreneur lists the company, and then it's a mechanism for accessing outside capital, right? And so ultimately the question is really going to be for the exchange of like, is there a marketplace? Do we think that there's an investor pool that's excited about this company or sees it as something that they'd want to place capital in, right? I guess that's the question, both for the entrepreneur as well as for the banker, and the exchange is really just the mechanism through which those things come together. Is that
exactly? Exactly. And I'm glad you pointed that out, because we aren't the ones who do provide the capital. We're sort of that in between, right? The intermediary between connecting the company to capital. My colleague Delilah actually coined the 4 R's, we call them, right? So we talked about reasons, and you're pointing out to the reality, right? So what does that reality look like in terms of getting, the investment bankers on board? Is there investor support both on the retail or institutional side? Is there sentiment for the company? Sometimes you see this a lot, right? A company who fundamentally fits all the boxes, but doesn't necessarily get the attraction of the investor base. So it is part of that, those categories. When we do look at the reality of going public, a big piece of that is the banking community, but also the local deal makers, and that's something we help with, by the way. So it's like we guide you through the process, we make all those introductions, but it's something that's definitely a very important part. And I think the banking community, why they're super helpful is because and obviously in part of raising the capital, but they provide clarity on valuations, expectations on how much you can raise within your financing. So they're the ones who have those conversations where we try to take a step back there.
Who is helping the entrepreneur along this journey? So if I'm in a lot of our audience is entrepreneurs who are in some cases working with kind of pre-revenue businesses, or in some cases they've bootstrapped it. Who are the people that come into play as an entrepreneur on this journey? Can you kind of talk to us about that? Because it's not presumably an entrepreneur who comes direct to the TSX or TSXV or any exchange for that matter on their own accord. Who is it? Attorneys? Are there investment banks? Are there investors? I mean, who are the people that are kind of working with the entrepreneur at this point?
Yeah, I mean, typically on that kind of roadmap, you'll probably have different cases, but I'll give you examples of maybe who the stakeholders are in part of that transaction. Right. So obviously you have the exchange, and that can come in at different points. You have obviously a legal counsel, right? And that can look as a mix of US and Canadian legal counsel that are familiar with the capital markets, that are active in the IPO space. You'll definitely have to have some investment banking support, obviously depending on the structure. But typically for IPOs or listings that are not direct listings, like what Spotify did, for example, which is just float a percentage of their shares without having to do any capital raising. I don't think they involved any investment banks. But for the most part, you're going to need some partners from the investment banking community, and then you'll probably need a seasoned accounting or auditing firm as well. And this is depending on where you are, right? If it's a very early stage company, you don't have necessarily the right audited financials and you need some support there, you'll definitely need that as a partner. So those are typically the 4 kind of key players, I would say. And then on the company side, it might be even VCs, right? Who are strategic advisors. It could be the board, it could be a director on the board, as an example, who has public markets experience, and they're helping you. As an exchange, we help you throughout the whole process as well. So from making the connections to investment banks and any other connections really to partners from the Canadian cap markets, we're there to sort of walk you through those processes. And then the bankers obviously are going to help you through that as well. So you do have a lot of support, not only leading up to an IPO, but I would say post IPO as well. Actually, one thing to note is our relationship management team right now has done a fantastic job of really creating different educational resources. We have something called the Sandbox, for example, which is a lot of these educational tools that companies may need, right? Especially on the venture exchange, like knowing how to properly disclose financials, knowing how to create materials that are sensitive, as an example. We recently launched a podcast to talk to issuers who are currently public, and just hearing their story, right? What their process was like, what they've been able to do, and how they've leveraged the public markets for their growth. So it's not like, we take you public and that's it. We're actually really invested in your success for the safety of the market, right? And the confidence of investors. So it's twofold.
Both ways. So I think it's an important point though for the entrepreneurs, which is that you want to surround yourself, be it through your investors, the people that are serving on your board, the investment bank that you've chosen to work with, the accounting firm that you've chosen to work with, that you've got people on your team that have sort of seen other companies across this journey and can advise you accordingly. I think is an important point. So we're getting some questions coming in, which is great. Encourage folks to put them in the chat. Alex Smith asked the question, and this is sort of related to your last point, George, which is there a typical amount of equity that is listed for sale in the venture exchange? So you talked about a company coming forward, and ultimately it's the banks that have to sort of determine the valuation. on the company itself. But can you talk a little bit about the equity split that entrepreneurs are typically thinking about when they come into an exchange?
Yeah, very good question. So let me maybe take a quick step back and also talk about the process, because I don't think we touched more so on that in terms of the venture exchange. But I think a lot of people are maybe familiar with the IPO, right? The traditional IPO on either the venture or the TSX. I think what's interesting about the venture exchange is actually, the most common and most successful way to go public is through a process that we call capital pool company. So it's not as crazy as it sounds, and I'll walk you through it very simply. I love to break things down into analogies, right? But very simply thought, I think if you want to look at the CPC program that we have, it's basically, and typically what we see is minimum of 3 individuals get together. Okay, these individuals, let's take an example. Alex is a serial entrepreneur, so he has the entrepreneurial background. I have the public markets background, and maybe you were legal counsel in your previous life, and now you're more involved in the public markets. We get together, we raise a seed round. Typically, it's around 100,000, and we take a shell public. So this shell really has no operations. All it has is cash on the balance sheet, and then you have a defined period of time, typically up to 2 years, to find a company to take public. And that typically happens through a reverse takeover, as an example, or maybe a reverse merger. But the reason why that happens more commonly and more successfully on the venture exchange is because, one, it typically takes less time. 2, it's a more cost-effective way to go public. We typically see a lot of the going public costs incurred as that shell vends and becomes publicly traded. So I think from that aspect, it might be more attractive to private companies on the venture. But also keep in mind, these 3 individuals who formed the shell to begin with are acting as strategic investors, right? Much like when you raise a VC round, you don't just raise it from anyone unless, you're really desperate. But if you're looking for VCs, the capital is one component, but also the strategic advisory is another. So these 3 players really help guide you through the whole process before and even post, right? And from there, it becomes easier to make different rounds of financings. So just wanted to make sure people know that that's actually a very common, very easy and successful way to go public for companies that fit the criteria. And in terms of equity, it really depends, right? And I hate to always say variable, and it's relative, but it really is a case by case, depending on your size, the complexity, the IPO raise, which exchange you're in. So it's tough to say. On the venture, I think sometimes it's more roughly less than 20%. But again, this is a very variable number. I'm happy to forward, I guess, case studies that more specifically position, different stories and different companies, just to show you how that would look like. So happy to do that for sure.
Great. We have a question. Curtis Drafton asks, is there a difference between the IPO and the private company kind of approach to finding capital? And I would maybe even broaden that to say, what trends are you seeing? We see things in the news like Spotify's alternative approach to going public, companies that are deliberately choosing to stay private, or in some cases have gone public but are then going private again. What are you seeing in the markets? What's the aperture and temperature for companies wanting to go public? Why would a company want to do that as opposed to stay private? And what are a little bit of the differences that you're seeing? Maybe also the profile of the types of companies that would go public versus stay private.
Yeah, no, that's a great question. In terms of, maybe we'll work backwards. In terms of profiles, honestly, it can be any profile, right? It's not, I know we're talking more about tech, life sciences, because that's typically what I cover. But whether it's mining, it's, in the diversified industries like communications and media, we have appetite for all sorts of different sectors, right? So there isn't really like a one bucket that one company can fit at. I think the main thing here, Todd, is what is the real reason, right? And we can help with that, right? So it's as simple as just having a conversation with myself and the founder or the CEO or the senior management team, and just walking through what those reasons could look like and which ones are right for the business. As I said, it could be acquisitions, it could be growth. In some cases, it could be liquidity, not preferable, but it could be kind of an ancillary feature. So I think the reason is super important, right? Does the management team really understand what the purpose of doing this is? The second thing I'd say, actually, and this is kind of interesting. If you look at the Midwest and think about how important life sciences is to this region, right? Aside from the coasts, a lot of companies sometimes are not necessarily geared for traditional VC. Right? And we know this, right? A lot of VCs are kind of specialized in whether it's software SaaS, or sometimes they're in the B2B space, or in very specific cases, CPG or whatever the case is. They typically have specific areas they focus on. For some companies who don't fit the traditional VC mode, this actually could be a pretty interesting financing option for them. One that's not as dilutive, one that's I would say more favorable to different types of stories, especially if they resonate with the public markets. I think it's also important to see from the company perspective, are they ready? And typically you're not going to find a company that's ready day one, but could you use this time to prep, right? In terms of the management team, getting the board of directors in place, audited financials, right? Just certain things in place where when you get your house in order, you can have a much more maybe easier time launching this sort of process.
Mm-hmm.
And I'm happy to talk about the private side as well. There's some interesting things that are happening there. So if you want to kind of talk about the climate or what we're seeing, but.
Well, let's pick up on this, that last comment, which is, what are some of the things you mentioned? Audited financials, you mentioned having a board. Are there common mistakes that early stage companies, those that are maybe still in the friends and family round, are there things that they could be doing to position their companies, sort of lay a productive foundation for having these options more readily available later on?
Yeah, that's a great question. And I, by the way, I'll answer this reasonably for both the private and the public side. This is something like, if you're asking me how would an entrepreneur set their business up for success, basically to access capital post, let's say, COVID as an example, whenever that's going to happen, hopefully soon. I'd say the first thing is back to that part where you educate yourself on the different options. Whether it's understanding more on the VC side, or right now you're seeing actually a surge in whether it's venture debt, you're seeing a bit of bridge loans as an example, or I know some VCs are doing convertible debt. You're seeing different options of financing. As a founder, I would just encourage you it's like a menu. When you go to a restaurant, just know what's on the menu before you make a decision. The second thing I do is, stay on people's radar, especially in the investment community, whether it's investment banks, VCs, whatever that option is and whatever is right. Just stay on their radar. And right now you can leverage Zoom calls. You can leverage different networking groups. I know there's an angel group called Karetsu. They do these presentations. Techstars did their demo day yesterday for Chicago, which was awesome to see. So there are different types of resources you can attach yourself with. The other thing is, I'd focus on the story post the crisis, right? I don't know if for accountants in the room, there's this new kind of metric now. It's called EBITDA with a C. So, your earnings post-corona. And I think just it's interesting to see or how you're going to highlight that story pre and post, right? So if you have a bit of sensitivity in revenue, growth, churn, or your burn rate, whatever it is that you track, and there's, it's pretty negative within this period, but then you see a rebound, I think most investors are going to be fine and understandable with that. And last thing I would say right now is you don't necessarily have to play to win. Right. I think that's kind of this is more of a mindset chat, but I think right now the best thing to do is focus on playing not to lose, right? Depending on where you are on the trajectory. So it's just a subtle shift. It's like if you're running a marathon and you hurt your leg, your first instinct is just to get back up and continue the race, right? Especially for a lot of founders. But sometimes it's okay to rest, recover, get stronger, and win the race the next year, right? So just keep that in mind.
Mm-hmm. Do you think that the environment that we're in is going to change future investor kind of appetite for looking at startups? What's your forecast on the chilling effect, or maybe the opposite, the sort of the opportunities that are being created in this environment? So can you give us a little bit of an investor perspective on what's happening in the moment, and maybe related to your last comment around EBITDA and valuation? Do you think that this sort of notion of business resilience will be, sort of maybe having more cash on hand, having more of a runway or a stronger liquidity profile? Is that going to sort of change how investors are looking at companies going forward?
Yeah, it's an interesting question, and I think whatever I'm about to say, obviously it's kind of a personal outlook, and I'm not kind of making any forecasts, but I was reading the report, and I recommend everyone do so as well. It's the National Venture Capital Association report. I think it came out like 3 days ago, but I'll summarize it. And it basically it highlights a lot of interesting themes. The first thing is, they've been highlighting that you'll probably see a slowdown in capital raised by VC investors, right? So that's the amount of capital they can deploy. I think the pace of the VC investing might slow down a little bit. One thing that I found actually really interesting was, if you look at right now, a metric in the VC space, they look at is dry powder, right? If you look at what they started the year with, it was about $120 billion in dry powder. And dry powder is basically the capital that's available to VC investors to deploy into startups. One of the things that's interesting to note is that dry powder, I think they're having concerns of whether they can deploy all of that given the pace that they had, before this whole crisis was happening. So I think that's an interesting thing to maybe track. And also keep in mind that VCs have, existing companies in the portfolio that they have to invest in, but also make way for new investments as well. That was one of the interesting things to know. The other one was, if you look at 2019, VCs in the US raised about 50 billion, but startups as a whole raised 133 billion. So if you look at that chunk that wasn't on the VC side, you're seeing non-traditional routes of financing, which is a good thing for the ecosystem. Things like corporate groups, private equity, asset managers. There are different pockets of capital financing that are non-traditional, let's say. But I think on that side, if their portfolios are like heavily exposed to private markets, they might want to look at diversifying or reducing their risk. And then on the M&A side, again, opportunities and challenges, right? Some acquirers might want more cash on hand. They might reassess strategies, or they might shop for companies at a pretty interesting discount. So that's kind of on the private side. On the banking side, or on the capital markets, listen, I don't want to be tone deaf. I think we're all we've all seen whether it's the volatility or kind of what's going on in the cap markets. But I think with that aside, we are still seeing some things that are quite positive. We're still seeing some financings take place, some acquisitions, and happy to highlight that. So I don't think it's all negative news. I just think it's going to be interesting how you position yourself. The gems, like the companies that everybody's targeting, they're going to be pretty okay. The companies that have raised before this crisis, they have some runway, they're going to be okay. It's the companies now that are strapped, looking for financing options, are pretty hurt from a business model, from what's going on. I think they're the ones who really have to reassess what to do.
Mm-hmm. Great. Well, we've only got a few minutes left, so I'll try to get through what questions we do remain. If you have them, please ask, and we'll see if we can follow up afterwards for those that we don't get to live. But how do you think about valuations? I mean, this is an area most entrepreneurs that we're supporting aren't, finance geeks and understands sort of the mechanisms around valuation. When is it relevant to know the valuation of your company? And are there simple ways to sort of, back of the envelope calculations without having to go hire expensive accounting firms? At some point, that's probably the right relevant action. But how do you help entrepreneurs think about the valuation of the company?
Yeah, it's a good question. I mean, obviously it depends on both the public and private markets, but I would say an easy one is just look at the market, right? Look at your total addressable market, start there. Look at real comparables within your whether sector or industry or vertical. Look at direct competitors and also size them up, right? So don't look at a competitor that's maybe, if you're a private early stage company, don't look at a competitor that's public with, $1 billion in market cap. So even if they're not a direct comparable, look at ones that are more closely aligned with your size, and see what they've been raising at. I know Crunchbase is a free resource, but for a lot of companies who know PitchBook or have access to it, that's a great resource as well, right? And just take a look at what they've raised, what the valuations were pre and post. So there's the pre-money valuation, which is your valuation before you raise money, post valuation, which is the money you raise, the valuation, post raising capital. So I think there's different free resources there that just give you a bit of a gist as to what's happening. But the final thing I'd say is don't get too caught up on the capital raising / valuation side, because sometimes those change, and it depends what we're looking at. On the M&A side, when I was working on sort of tech M&A, the exit multiples were very different than what companies were raising in terms of growth multiples. Right, so the multiples they were getting on what they were raising from a VC round was very, very different than when it came time to maybe exit their company. And sometimes there are disappointments, right? Because the expectation is maybe 10x, and then you exit at maybe a 2 or 3 times revenue. So just make sure you have reasonable expectations of your valuations, both for private and public, and make sure to really have proper financials to back up the story, right? Even though a lot of this is based on assumptions and hypotheticals, I would just say, understand the right metrics for your space, but also be very, very diligent about as to how you tell your story, because you have to back it up, in any case, whether it's a base case, an optimistic case, a neutral, so just make sure you have ammo for it.
Yeah, that's great. And particularly to this question, or what you said earlier, George, was this idea of EBITDA and then EBITDA C. I think for the entrepreneur, you've got to be able to tell stories of different scenarios. And it's less about having the answers. I think it's more about having thought through the various scenarios and saying, there's this idea of, I think General McChrystal coined, known unknowns. Maybe it wasn't him. Maybe that's wrong attribution. You got to know that with the military community. But this idea of known unknowns, it's known that we don't know when the markets are going to sort of open back up, but we can plan for optimistic and pessimistic scenarios. And I think investors want to know that the entrepreneur has, plans according to the different scenarios. And so even though we don't know the answers, we can sort of build and prepare for some of those scenarios. And I think that's important for all of us. I'll make this the last question.
Sure.
And well, I'm gonna ask two in one, but one is sort of, can you talk a little bit about crowdfunding? How does that relate to, or I'll even broaden this to say, and this is a question from Reginald, what other, coming into a market, are there things that either appear as attractive or unattractive for companies coming up to that point? So is it helpful that a company shows up having had a successful crowdfunding campaign, having had friends and family, or is it attractive not to have had those things, that the company is undiluted in a sense coming into a market or an exchange? That's sort of a technical question. And then I guess the final question that I'd ask is just what's your forecast on when markets will open up? And obviously knowing it doesn't represent the Toronto Stock Exchange, but just your opinion as someone that's close to this.
Yeah. Great.
Or
questions.
are the markets back open? I mean, that I guess would be a different way of asking it.
Sure. So the first question in terms of, raising the friends and family and angels and crowdfunding. Listen, I think there's definitely an arena for crowdfunding to play for different scenarios, right? I think it makes sense, especially given what's happening now. Like if you're really strapped for cash and you're having a difficulty managing cash flow and there's no other capital options right now, looking at crowdfunding isn't far-fetched. What I would be concerned with, and this is kind of across the board, is just having a very messy cap table. The last thing you want is having hundreds of people on your cap table at very small increments, because when it does come time to raise maybe a more credible round, whether it's a VC, private equity, or even public markets, that could be a concern. And I've seen that both for raising money, but also when you do exit. I've seen that on the M&A side, actually, when you plan to maybe sell your company or get it acquired by another, that could make things more complicated. So just what I would preface is know your options, but really understand the pros and cons to each, because there definitely is, right? As much as there's benefits for public markets, there are challenges, and just like there are for any fundraising option that you have as a founder. So that's what I would say to that. And then in terms of outlook, it's funny, man. It's tough to say, because at this point, this is what I hear for a lot of founders. All we have visibility on is the next, let's say, month. And that's the best thing that you can do right now, is just as a founder, as an entrepreneur, plan for the next 3 to 6 months as best as you can. And as I mentioned, that mindset of playing to not lose is important. A lot of startups right now are running into a dead end, essentially, and it's unfortunate. So if you're one of the lucky ones who are wearing the right hat, pivoting, figuring out how to be of value to your customers, deploying marketing strategies that aren't BS necessarily, I think that's important. And also preface the fact that your reputation will carry on when things settle. Always remember that, right? As a founder, as anybody really listening. So
that's a great point.
Don't try to skim just because of what's happening and seem to forget that when things settle in the next X amount of months, I don't know when that will be, your reputation is still going to be there, positive or negative. So my hopes is that they're looking at June, Todd. I live in the Gold Coast in Chicago, for anyone in the city. So I'm just excited, man, for things to be sunny and I can go run by the lake again. But yeah, I hope everyone's doing well. And for any follow-up questions, I will say, please connect with me on LinkedIn. Feel free to reach out. I don't know if you probably have the link to my email or whatever other resources, but happy to connect and answer. I know this was kind of congested, but
No, this is great.
A lot of
George
great.
Khalife, thank you so much for these insights and really lots of rich stuff. And yeah, we will provide your information and just a really good primer on thinking about the capital markets and the options that are available, and also some wisdom about how to get prepared. So thank you. And Jada, I'll turn it back over to you.
Thank
Thank
you.
you.
And thank you to you, Todd and George. Thank you so much for giving us a lot of great insight to making the right money moves and for sharing the power of planning during these unknown times. And thanks again to our community for joining us today. So why don't we all give each other a virtual round of applause? There you go, little claps. And again, thank you so much for being a part of our community. Please stay connected with Bunker Labs and our speaker, George, through LinkedIn, Facebook, Instagram, and through our website, bunkerlabs.org. And we will see you at our next town hall. Stay safe and take care. Thank you,
Take care,
everyone.
everyone.